OPEC's energy market weekly updates. Crude oil futures Friday were climbing higher, but having last week slumped below pre-level levels as a wave of bearish sentiment and fears of a demand destruction swept through the market. Middle East crude oil finished the week nearly 7% low, broadly following the global sell-off in oil markets. Neither OPEC's modest production hike nor Aramco's record OSPs did little to arrest the slide. Dubai cash for October delivery was assessed around $93.8 per barrel for August the 5th on a Singapore close, down almost $2 from the previous session, while front month October JPEX Dubai were trading at equally $86.3 per barrel. At the same time, IC Brent futures were trading at around $95 per barrel, both at a level not seen since February of this year and before Russian invaded Ukraine. Prompt intermonth spread for these crude oil futures rallied after several days of decline, but still remain weak. The OPEC Plus alliance announced a modest 100,000 barrels per day rise in production quota for September, a slight gesture to the U.S. President Joe Biden, who pressured for more supplies to tackle high prices, but also a big nod to Russia and other members that sought measured approach to protect their windfall earnings. The core OPEC group pumped around 28.98 million barrels of crude last month, Reuters survey found, up over 300,000 barrels from June's revised total, but still 1.3 million barrels under target. The biggest increase in production of 150,000 barrels a day came from top exporter Saudi Arabia, while the kingdom's September quota calls for a further increase of just 30,000 barrels a day. However, it's assumed that OPEC Plus group oil production will grow 500,000 barrels per day from July to August and remain at that level through the end of this year, given that many members have been struggling for months to hit their output targets. OPEC Plus also flagged the severely limited availability of excess capacity, necessitates utilizing it with great caution in response to severe supply disruptions. Prices were once briefly lifted Thursday after Saudi Aramco hiked price differentials for its flagship Arab Light grade to a record of $9.8 per barrel for loading next month, compared to the previous record of $9.35 per barrel in May. Although widely expected, the increase was seen as evidence that Saudi Arabia sees no difficulty in placing September barrels. On the demand side, recessionary fears have been flagged in Europe, where China's post-COVID recovery has proved sluggish amid on and off restrictions. China's crude throughput likely fell in July, weighed on by maintenance at state-owned refineries amid uneven oil production, demand recovery, and limited exports. However, the sell-off was largely spiked by the later EIA data showed the demand for gasoline in the United States last week had fallen to the pandemic levels of 2020 due to high prices. Gasoline refinery margins also fell to levels last seen before the war in Ukraine started. Although investors will be eagerly waiting to see if this was a blip in data or a new normal, it also highlighted concerns over falling demand. At the same time, GasBuddy, which services transactions at 150,000 gas stations in the United States, saw 2% weekly increases or 9.5 million barrels per day gasoline retail data, the highest so far this year in the United States versus the EIA's 7.6% drop. The discrepancy in demand data could, however, be explained by the forecourts cutting back on their forward purchases after wholesale prices tumbled by nearly a third over the past 2 months. Another relatively reasonable data is that the agency's gasoline demand data, which measures the amount of product left at major storage sites like refineries and bulk terminals, does not fully track how many gallons drivers are buying at the pump. While gasoline demand did come in below expectations heading into the summer, the weekly data provided in the EIA report can be highly volatile from week to week and do not necessarily reflect demand trends. The EIA's monthly gasoline demand data is much more accurate, but investors will have to wait nearly 2 months later to find out. Okay, that's what I want to share with you today, and welcome back next week.